We are entering the danger zone where bad things happen to the business cycle due to policy lags. Joining me now is Michael Darda, the chief economist and macro strategist at Roth MKM. Mike, it's great to have you back. Welcome.
Thanks for having me on, Kelly.
I didn't think this was a debate, but let me start with the fact that you still think there are lags, because there are some in the camp that say the lags are gone. Everything's priced in immediately because of forward guidance and so forth. And I don't know. I've never quite bought it, but I don't think you're a buyer of that narrative.
No, it doesn't make much sense to me. And the same people are telling us that the economy's less rate sensitive now because everybody locked in low mortgage rates a few years ago. Well, if anything, that means the lags are still there, but they're potentially longer. So it's just not a coherent argument. We look back at history, and what history says is the lags are there, they're long, and they're variable. If you're looking at something like the yield curve or money supply figures. And, these indicators started inflecting, just over a year ago now. And so we're moving into a zone here where things start to break. Now, look, I admit, economy's held up better than I expected this year, especially after the regional banking crisis started in March of this year. But the fact of the matter is that I think we're headed into more difficult waters here as we move into Q4. Q3 looks fine, but it's behind us now.
I like what you said about how the mortgages might actually mean the lags hit with an even bigger lag than normal. Let me ask you, we had Dave Zervos on yesterday, who was getting into kind of the former QE and the size of the Fed's balance sheet and saying maybe that just continues to act as stimulus in the economy. It continues to act as a shock absorber. It means we have to raise rates even higher in order for them to have an effect.
Yeah, that's certainly possible. If the neutral rate is higher, then the Fed has to go higher to get the desired effect. But that's effectively what they've done, right? I mean, this policy tightening cycle has been much more dramatic than the last one. And what the Fed is telling us is they want below trend growth. They want rates at restrictive levels, and then they want to hold there. So if this Q3 data that everybody's all excited about with the Atlanta Fed numbers, if that looks like it's sustainable, the Fed is just going to be back at it with the rate hikes again. So eventually they're going to get the slower growth that they want from restrictive policy. And that's, I think, when the long end of the curve starts to turn here. I thought it would be sooner than this. I didn't expect to see the 10-year up at almost 5% this week.
Right.
But, those claims figures today were good, at least on, the initial claims, and the bond yield failed to continue rising. So maybe we're just getting to the point now where, this most recent surge is over. But in a recession scenario, you want to buy the long end of the curve. The utility stocks are down almost 20% in the last 6 months. So I think it makes sense to be more of a contrarian here than just, than to be joining the soft landing happy dance at just the wrong time.
So you say that yields have overshot to the upside. I'm curious, by how much do you think? And I obviously for those who think, well, no, the economy is going to be fine, then maybe it takes longer for any of those arguments to take hold. But again, I mentioned there were kind of three reasons why people think we're going to have structurally higher rates, and you're not really buying any of them. And the deficit's one of them.
Yeah, I mean, that's, probably the trickiest one, because it is quite unusual to see a fiscal deficit at 8% of GDP at full employment. Frankly, it's absurd. But keep in mind that the 10-year yield was at 3.30 6 months ago. And so, what's happened really is a surge in what markets are expecting in terms of short-term interest rates staying at elevated levels. The 36-month Fed funds futures yield has jumped 150 basis points over the course of the last 6 months or so, and that perfectly tracks the move up in the 10-year yield. And you have people talking about a potential return to the 1970s, but obviously failing to actually look at the component parts of the 10-year Treasury. This is a real rate dynamic that's unfolded here. And at the same time, you've got copper and other sensitive industrial metals rolling over hard, still inverted yield curves, still very weak money supply figures. I mean, If that's the 1970s, then Klaus here and I can switch places.
Also, is it true that inflation break-evens this week in particular have moved lower? This was something that Brian Reynolds were highlighting. He was focused on the one-year inflation break-even, but he says it's plummeted this week. Meanwhile, after the Fed meeting, we've also started to see high-yield or junk spreads widen out, and some of those indicators of the business cycle really finally starting to turn.